UK inflation just jumped higher than expected. The latest CPI inflation report published today shows a rise of 3% for CPI in Jan 2025, up from 2.5% in December 2024. What does this mean for interest rates, mortgages, and your cost of living? Will the Bank of England cut rates further, or are we in the financial turbulence? Stick around as I break down the numbers, explain the impact, and tell you what you should do to stay financially ahead. Inflation breakdown. The numbers you need to know. Latest inflation figures. CPIH inflation, including housing costs, 3.9%, up from 3.5% in December 2024. CPI inflation, consumer prices index, 3% up from 2.5% in December 2024. Core inflation, excluding food, energy, alcohol, tobacco. CPIH core inflation, 4.6%, up from 4.2%. CPI core inflation, 3.7%, up from 3.2%. Monthly inflation movement, January 2025. CPIH, no major change, but last January saw a 0.4% fall. So prices are now holding up instead of declining. CPI minus 0.1% monthly change. Last year, minus 0.6% fall. Biggest contributors to inflation. Transport cost increase. Food and non-alcoholic beverages up. Education costs surge due to VAT on private school fees. Wage growth versus inflation. While wages grew by 5.9%, inflation is still eating into spending power. Inflation is rising when it should be stabilizing. This puts the Bank of England in a tough spot. Bank of England and interest rates. What will happen next? Recent interest rate cuts by the Bank of England. August 2024, 5%. November 2024, 4.75%. February 2025, 4.5%. Governor Andrew Bailey warns future rate cuts will be gradual and cautious as inflation risks remain. Now the big question is, will interest rates keep falling? Short answer, likely not so soon. Inflation is expected to peak at 3.7% by mid-2025, meaning the bank might hold rates steady or slow future cuts. Energy prices, transport, and rising wages are pushing costs up. Mortgage rates could stay higher for longer as lenders anticipate future inflation. This means that if you are waiting for a massive drop in interest rates, you might be disappointed. How this affects you? Mortgages, savings, and wages. Mortgages and loans. If you are on a tracker mortgage, you might see some relief. Fixed rate mortgages are unlikely to drop much further in the near term. Savings and investments. If inflation remains above 3%, your money is losing purchasing power. What you should do? Lock in high yield savings accounts above 4.5% to beat inflation. Consider low risk investments that outpace inflation. Wages versus inflation. Average wage growth 5.9% up from 5.6%. Real wage growth after inflation 3.4%. So wages are rising faster than inflation for now. Private sector wages are increasing faster than public sector pay. While wages are rising, if inflation accelerates, those gains could be wiped out. So now is the time to be smart enough with your money. Global inflation. How does the UK compare? UK inflation CPI 3%. Eurozone inflation 2.5%. US inflation 3%. Global trend. Central banks worldwide are slowly cutting rates, but inflation is still a concern. This means the UK is not alone, but we need to be prepared for persistent inflation. What is next? Predictions and what you should do now. If you have a mortgage, consider fixing your rate if you are worried about future rate cuts slowing down. If you have savings, Move your cash into high interest accounts to beat inflation. If you want to invest, focus on inflation resistant assets like stocks, property, or inflation linked bonds. The key takeaway: don't wait for inflation to disappear. Plan your finances now. If you like the video, please subscribe.